Thanks for the kind introduction. It's quite humbling to follow in Paul's steps. He's cutting a real blazing a trail in sustainability reporting, and I hadn't thought that I was going to be able to make a comparison between these two individuals, but seeing as we're in Singapore, I think it's fair to say that Paul is sort of like the Lee Kuan Yew of corporate reporting, in terms of he's bringing a vision and structure to corporate reporting, that the kind of corporate reporting that can underpin the long-term symbiotic wealth creation. And I have a great regard for both those men. I recently finished Lee Kuan Yew's autobiography on my honeymoon, and I'm happy to report that I'm still married. So I'm going to go down a little bit more into the weeds around sustainability reporting at the level of stock exchanges and companies on stock exchanges. And I have a few key points that I hope I can leave you with. And I'd like to start with some of my key points and finish, and then there's a better chance I'll remember, and then hopefully some people in the audience too. So point number one that I'd like to make is that we've now reached critical mass for certain sustainability indicators being reported by large companies globally. But that critical mass has plateaued over the last several years. We've seen a plateauing after a lot of growth in sustainability reporting. It has plateaued. So that's number one. Number two, we used to have a question we asked, which was, do investors care? Do investors use sustainability data information? And the answer used to be, I don't know, probably not. And it was a bit of a chicken and an egg, and there wasn't enough data being reported by companies in order for the investors to use it. Now there is on certain metrics like carbon, and investors are using this data. There's already billions of dollars of money running on low carbon funds that are premised on carbon data reported by companies. And so this number is expected to grow into the $100 billion range by end of this year, and into the $1 trillion space in the not too distant future. So real money is moving on sustainability metrics, particularly carbon now. So the time to serve investors has arrived. Number three, there's something that's happened in this sort of kind of race between the chicken and the egg of reporting and whether investors want to use it. And what's happened is we have a bit of a wild west of sustainability disclosure happening right now. You have some places with rules, some places with no rules, some places in between. And you have a lot of people who want this information. People like my company, Corporate Knights, we do rankings, and we create indices, along with folks like the CDP, the Carbon Disclosure Project, who do things to the Dow Jones Sustainability Index. And all these folks, Sustainalytics, MSCI, they all have interactions with companies and are asking them for data. And what's happened now is you have many big companies who are disclosing what I would describe as potentially material indicators, certainly indicators that investors are using to move money on, and they're disclosing them at separate times to separate actors. And that's the definition of selective disclosure. I don't think it's intentional, but it's happened because regulators have let it happen and have not stepped in with clarity and requirements around data to clarify and to get this kind of information out in the marketplace. So let's move into some of the action. A little bit about the report. This is we do an annual report ranking stock exchanges on how well the companies listed on the exchanges disclose sustainability data. So this is the third year we've been doing the report, so we've been able to detect trends. It's an analysis of all companies in the world that are on stock exchanges that have a market cap of 2 billion or larger, and we look at 7 different metrics that I'll get to. The audience is for stock exchanges themselves, and for investors, and for regulators. And I'm going to whip through some of the stuff, and I'd be happy to share the report. I've sent it to the organizers, and anybody who would like a copy who can't keep up with the furious pace that I think I'm going to have to keep to hit the 12-minute mark. So the 7 indicators you can see at the bottom here, employee turnover rate. These are all indicators that are reported by companies in every industry, and a case can be made that they're relevant to every industry. Some industries more relevant. Employee turnover, energy use, greenhouse gases, injury rate, payroll, water consumption, and waste generation. And so key results from the ranking. These are the top 10 exchanges in the world. You can see There's one from emerging markets, Johannesburg, and that's largely a result of Mervyn King's work that Paul referenced earlier in setting up reporting requirements for companies on the Johannesburg Stock Exchange. You can see that of the 10 top-ranked exchanges, that third bullet point, they all have something in common. All of them have a mandatory and clear and prescriptive policy requiring disclosure of companies listed on the exchange. So 10 out of 10 require companies to report. Surprisingly, not surprisingly, those are the ones with the leading disclosure. And if you look at the bottom 10, you find a similar story where you have 10 out of 10 that do not have a clear mandatory requirement for sustainability disclosure. The bottom-ranked exchange this year was from Peru. It was the Lima Stock Exchange, and they ranked number 46 out of 46. And when we launched this report in Geneva at a UN event, there was a lot of the presidents of the stock exchanges were there, and so each one of them got a copy of the report. And the CEO of the Lima Stock Exchange, he got up and he made a speech, and he announced he was going to join the Sustainable Stock Exchanges Initiative. And he made the comment that we can only go up, having ranked 46 out of 46. So it's good to see that the message is getting across. So some of the key results from the ranking: we saw a lot of improvement in emerging markets, including some folks in the immediate area here, Malaysia and the Philippines, Thailand. Turkey was the most improved. Singapore also did improve substantially. The quickest reporters, and this is really important for investors, the quickest reporters are the Shanghai Stock Exchange and the Shenzhen Stock Exchange. They report the data in almost real time, and so you don't have to wait 6 months or 10 months to get the sustainability data. So it's interesting to see how China is starting to really stake out a leadership position. And I think this is going to be a particular challenge for Singapore, as Singapore embarks upon this question of how the comply or explain principle will be implemented. And timeliness is key. And Singapore is ahead of Hong Kong in almost every respect, except for timeliness. And I think there's a real opportunity for Singapore, an exchange that's only got about 50 companies that are 2 billion or over versus Hong Kong, which has 200 companies over 50 billion or over. There's an opportunity for Singapore to carve out a space in Asia, is the place to go if you really want to know the whole story on the company. And that's something that could be quite attractive for investors, and I think help to bolster the growth, the sustainable growth of Singapore. The most improved exchange is Turkey, as I mentioned earlier. If we go here, this chart is really instructive. It really boils down a lot of our work over the last 7 or 8 years, and it shows the number of companies disclosing these metrics over time. And as you can see, there was a fairly substantial improvement in the environmental indicators over the course of 2008 to 2010. And then you can see after 2010, it's roughly tapered off, and this is the plateauing. And I think what it suggests is the voluntary bus has taken us about as far as it's going to get us. And in order to, we now have figured out how to do sustainability reporting for the first generation metrics. And in order to take it to that next level, there's 4,600 companies we looked at here. And you can see that by the metrics that we have less than half reporting most of these indicators. But we have substantial numbers, hundreds and thousands in some cases. Now is the time for regulators to step in and clarify the marketplace. This is disclosure trends across these key indicators, and these are for globally. As you can see, payroll is the most widely disclosed metric. Energy and GHGs follow after that. And injury rate is the lowest. If we go to the next one, this is just the disclosure for the 500 biggest companies in the world. So companies that are over 20 billion or more in most cases, and the 500 biggest companies in the US. And so what it shows on the right is it shows that metrics like energy and greenhouse gases and water are roughly, they're table stakes now if you're a big company. 3/4 of big companies, the Global 500, are reporting both energy and greenhouse gases. So this is something, if you went back in time 10 years, you're talking less than 10%. So this is good progress there. This metric shows the growth in Scope 3 reporting of greenhouse gases. You can see it's fairly meteoric. It went up from around 300 to getting close to 900. However, the data is still not ready for prime time because there's such complexity within Scope 3. So this is more of a begin to do than a sort of being done comprehensively. If we look at the audit picture, we can see it's plateaued somewhat, but you have upwards of 1,000 companies now doing some form of audit of their sustainability reports. That's a good trend, including some notable companies here in Singapore, like CDL. If we go to the next one, you see the top 10 exchanges by speed. So as I mentioned earlier, China is right there at the top. You can see Italy coming at number 10, Johannesburg number 8. Australia does quite well. And Australia actually, I think, is a pretty interesting model for Singapore on disclosure rules, and it's also in the same part of the world, and timeliness is the exchange here is looking at what guidelines to reference. If we get to the next slide, some recommendations. So there's a few recommendations here. Number one, it's time for policymakers to close the loop. And so I'd like to applaud what's going on in Singapore and the decision by the SGX with the support of regulators to implement the comply or explain principle, which is similar to mandatory reporting, because it's pretty embarrassing to say, we couldn't do a report if you're a publicly listed company on sustainability. But I would like to strongly encourage the regulators and the people at the SGX to consider adding a little bit of prescriptiveness, not a lot, not too much, but a little bit of prescriptiveness, and to look at what the London Stock Exchange did and consider requiring all companies to report their carbon emissions is one level of being specific in addition to a sustainability report, or to explain why it's not, why the company doesn't feel it's relevant to disclose carbon emissions. The time gap is a big issue. And I think in order for investors to use this information, it has to be timely. The ideal scenario is that it's integrated into the financial reporting cycle in terms of the data points, if not the sustainability report, but the actual sustainability data points. And number three is to help play a larger role in the harmonization of all these reporting standards that exist out there. And Paul is a great resource on that front. And number four is for investors to start to make use of this data and to create indices and impact products based on this data. So this chart here shows why it can matter. Some people say, why is this interesting? And I think that in this big pile of sustainability data, there's actually some interesting outperformance stories. It's not about sacrificing performance always. So with the carbon picture, this is an index that we recreated out of the S&P 500, and looking at the 500 biggest companies in the US, and then taking out the carbon inefficient companies in the high carbon sectors, so where carbon is material, not where it's not, and then increasing the weight of the carbon efficient companies in the high carbon sectors. So basically making a bet on the efficient guys in the high carbon sectors and excluding the inefficient and the non-reporters. And you can see that a strategy like this, you could reduce your carbon emissions in your portfolio by over 50%, in this case 56.7% against the benchmark, and have outperformance. That's not guaranteed always, but it's interesting to see that in this case, a rules-based approach of making a bet on the more efficient companies in the high carbon sectors generates 7.8% of outperformance from the beginning of the testing period in 2008 to now. And so that roughly concludes my remarks, and I hope I see the time's up sign, so I hope that's good timing. And I'd be happy to answer any questions, and thanks for listening to the presentation.